Well, the all-share index has moved in and out of positive territory this session, with financials and industrials exhibiting slight gains. Mining counters, which were on a roll yesterday, have retreated, particularly gold miners. The local currency is more or less flat on the New York close, hovering around 11.85 against the US dollar. And over in Europe, equities markets are broadly up. This after the European Central Bank indicated that it could withdraw its QE stimulus program by September this year. This has put upward pressure on the euro, which is negative for European exporters. And globally, observers are concerned about the US trade's protectionist tendencies. Let's take a look at the indicators. Well, I'm joined by Warwick Lucas. He's Chief Investment Officer at Galileo Capital. Thank you for joining us, sir.
My pleasure.
Good stuff. Currency markets have been somewhat confused, what with US government officials talking the dollar down and Donald Trump now talking the dollar up. And on top of that, the US has been very active in its trade protectionist tendencies, levying big tariffs on particularly washing machines and solar panels, which happen to come from South Korea and China. Now, if this trade protectionist talk continues, what sort of impact could it have on global equities, which have been doing very well this year?
Okay, so far we've seen the dollar in 1 month go from 118 against the euro to 124 today. We've seen similar trade against the yen. So I guess it's just building on an environment for a basically weaker dollar. I mean, we've seen that the fiscal policy is really tending towards inflationary. I think in that context, it's actually going to be more like a sugar rush to markets than something that's immediately and sustainably beneficial, although perhaps longer term, yes. And trade protectionist simply adds to that, adds fuel to that fire. So, yeah, I mean, it's potentially got inflationary consequences for the US, and as to whether that filters elsewhere into markets depends on the degree to which US markets are insulated.
And then let's look at local news, because we have very limited time today. The local all-share index has been particularly doing well in terms of the financials, the financial stocks and gold counters. When you look forward, do you think this is sustainable for these specific counters?
Well, given the inflationary position that I described just now, I mean, clearly gold is a beneficiary of that. So from that point of view, I would have said yes. As far as banks go, I think just a moderate improvement in the local environment from bad to less bad is really all that they need to be able to start expanding their lending books, because they really have been on a very contractionary footing.
Now, Deputy President, Cyril Ramaphosa, was out at Davos. He says that he and the delegation are coming back with lots of goodies in terms of commitments, investment commitments that have been made towards South Africa because of improved sentiment. And we've seen that the rand has firmed quite nicely, and people are talking about South Africa being the next emerging market bond frontier, being sexier relative to its peers. Do you agree with this? Is this just honeymoon talk, or do you think things are changing?
I do think things are changing, although I think there's going to be a certain number of commitments that would have been made, or promises made, or nuances, etc. I mean, as far as the rand goes, though, it is a reasonably easy story to tell. I mean, on a purchasing power parity basis, the rand is still really very cheap. And I guess the other story is, well, what's going to happen to the issue of our credit rating? I mean, we still on investment grade with Moody's, and I think certain things have to be achieved in this latest budget to keep that, and that's going to have to mean quite a tight budget. So it's conditional.
And while you're on the issue of the budget, Malusi Gigaba is saying in Davos that very tough decisions are being taken to bring down the budget deficit. Clearly that means tax hikes. Where can he, tax us without preventing us from growing, because things are looking better now?
Look, it's got to be brutal. South Africa is really very limited in its options. The usual suspect is, of course, fiscal drag, i.e. leaving taxes in place and letting inflation do the work. But above and beyond that, I mean, South Africa's economy has long been out of whack between its supply side and its inherently strong demand stroke consumption side. I suspect that, or alternatively some other kind of consumption tax, must surely come to the fore in coming for assessment.
And what are the implications if they levy higher personal income tax, do you think?
Well, I think that's it'll act as a serious constraint on demand as a whole, but also skew investment. I mean, the investing side of the economy is it's just gone nowhere for ages.
Well, we're going to leave it there because we don't have much time. Thank you so much, as always, for your insights. Some analysts are saying that with the personal income tax levels already, some people have already left the country, and of course they're employing tax avoidance measures. So it's going to be a very tricky budget. We have to wait and see. After a short break, Nzinga has more business news for you.